Welcome back to Compound Thesis. Our guest today is Nick Cannon. He's the VP of Growth at Gauntlet. Now, a few months back, we had Tarun, actually the CEO of Gauntlet, on the show discussing your day-to-day on risk management for protocols. But today, we're going to take a look at your new protocol, Aera, which is focused on helping DAOs manage their treasuries. Nick, welcome to the show.
Hey, thanks for having me.
So before we dive into Aera and anything in DAOs or crypto, just wanted to kind of get your thoughts on just an overview of what does treasury management mean? It's typically probably a boring function not many people talk about until looking at crypto, and a lot of attention has been put towards DAO treasury management. So can you give us a sense of like who's typically responsible for this function? What are the goals, type of investments that they make or hedges that they put on for their business? I'm sure it's different if it's, a bank or an airline, but just curious if you could kind of give us a baseline, and then we'll discuss how, DAOs are similar or different, and kind of looking through what the goals are for treasury management as a general function.
Yeah, I guess in tech or traditional finance, unless you're inside the company or maybe it's public, you don't have much insight into treasury management. It's probably, as you mentioned, a very boring function. There's a CFO making a lot of these decisions and budget requirements and sort of allocations, and there's not a lot of visibility into it. And definitely, what's unique about DeFi and DAOs is the visibility that there is. These treasuries are on chain. So not only the stakeholders or everyone participating in these DAOs, but like the customers as well have visibility and transparency into this, which is exciting, but adds a lot of friction to the process of management.
Yeah, absolutely. And so because this is kind of behind closed doors, might not have as much direct insight, but what is the typical goal for a treasury management function? Is it to, maximize return on assets? Is it mostly to protect the capital of the business? Is it, optimizing cash flows? Just, kind of give us a sense for how they think about the KPIs or goals for that function.
Like every market, there's risk on and off environments, or growth modes and then build modes. So this sort of depends on the cyclicality of the sector or the business that you're in. If you just if you're a tech startup, you just raised a funding round, or you hit your Series B, for example, and they call that the growth round. You're surely pouring that onto hiring, right? And you're not exactly trying to balance revenue or ARR goals exactly with you're pouring some things into R&D more than you had previously, and you sort of have a target or presumably product market fit that you want to put some cash on that fire. Yeah, it's definitely complex, and it's tough to get insight into that always. And maybe the frictions that we're seeing on the DAO side of things is that just coming to light, where nobody and everybody is in charge of treasury management.
Right. Yeah. I mean, there's no CFO necessarily of a DAO, right? The decentralized nature of it means that the community is kind of running it. And, as you mentioned, there's a lot of visibility into it. So let's pivot into the DAO, kind of sphere. So what's at stake for DAOs? If as you look at, some of the metrics, I was looking through Deep DAO earlier before the call, and, a lot of it's highly concentrated in the tokens, the native tokens of a particular protocol. But, just curious, what are you seeing in terms of what is a DAO treasury? Like, how is it structured, and what kind of assets do they typically hold?
You got it right. Most of the DAO treasuries are the primary native governance token, which is usually funded by initial allocation at that token launch. Say there's a billion tokens, 10 to 20, 30, 40% of those tokens are allocated for the treasury, with the sort of a high level mandate usually of these are the things that we might use as expenses, operating expenses, grants, risk management, service providers, or things like that in the future. Largely, it's loosely scoped because they don't really know what those needs might be, and those are definitely changing over time. There has started to be diversification, primarily one-off diversification into stablecoins, as hey, crypto is volatile in risk-off environments. You want to make sure you have runway to do so, and that has been the majority of sort of treasury management to date for DAOs.
So it seems like the assets on the balance sheet are in the native token, but the liabilities, so service providers and or their infrastructure costs and or other expense line items, as well as like insurance or reserve funds, like those may or may not be in the actual DAO token or the native protocol token. So how are they trying to diversify today? It seems like it, as we look at some of the metrics on chain right now, it's highly concentrated in the DAO token or in the protocol token, but are there more actively managed strategies to diversify the balance sheet and to try to match assets and liabilities? And what kind of evolution are you seeing there?
Yeah, there's not too much, and as you mentioned, majority of people don't want to be paid out in the governance token, and there's a good reason to distribute the governance token from the treasury in that, right? It helps diversification or sort of broadening the user base and stakeholders in the protocol, which hopefully gets more eyes and qualified people to help participate and grow and sort of have a skin in the game as everyone's still trying to find their fit through thick and thin sort of cycles. You are starting to see, as mentioned, these US dollar stablecoin diversifications for a number of reasons. I've seen polls from grant participants who are taking anywhere from, small thousands to tens of thousands in, grant applications to build things on top of protocols like Compound and others. But they don't want the, native governance token exposure. They don't want to worry about the tax liabilities of that taxable event of exiting out of that position to sort of fund those development efforts. And so the DAO and that responsibility has largely come to what have been sort of the spin up of ad hoc treasury managers. Sometimes they're internal to the primary core team that built the protocol. Sometimes they're funded directly by the DAO as hey, this is your job. These look into what the assets and liabilities are in a lending protocol case, or look into the OPEX for a DEX and tell us like how many funds we need for the foreseeable 3 years that we can sort of predict sort of the development roadmap or something like that, and just make sure we have enough cash to do so. Then you have to go and get consensus through a forum or a governance vote, which is extremely difficult.
Is there a lot of participation? And I mean, this seems like not the most interesting part of running a DAO, the capital management side of it. I think a lot of the DAO participation typically gets, the members get excited about new initiatives or innovating on the actual protocol, the actual technology. But this is like the boring aspect, as we said earlier, about DAO treasury about treasury management in general. Are you seeing, are folks actually excited about this? And how, like you mentioned, there's some forecasting that's done for like a multi-year timeline. Is that commonplace across many different DAOs, or are you seeing, that a few folks are more forward-looking, trying to forecast like what their goals, their KPIs, what their metrics are, versus, just trying to run this on an ad hoc basis?
Unfortunately, more people are forward-looking in bear markets when maybe it's a little too late, and the asset value of their governance or treasury is significantly less, in some cases down 90 to 95%. Better late than never. So on the participation, I think in most cases this is actually boring, right? Treasury management, you're effectively balancing a checkbook. Who is particularly excited about doing that? But why it's so active and actually riles a lot of feathers in governance and in forum is that to do so, to make these diversifications or budget planning, you need people to vote, and you need people to vote and often put downward pressure on the governance token they're holding. So they need to vote with that governance token to put sell pressure on that same governance token, which causes all the opinions to come out, which is quite rare the case in sort of what is universally known as voter apathy, across DeFi.
Yeah, there's definitely a mismatch there in terms of incentives, right? Because you're long the token and the success of the future growth of the protocol, but at the same time, in order to actually implement change, you are advocating for diversification of the treasury, which inherently means selling down the assets on the balance sheet, which are the actual token. So there's definitely a mismatch there. And I think that's kind of maybe a good place to transition to what Aera is doing. So for our listeners, can you just give a kind of quick overview of Aera and how it works?
Yeah, Aera is a protocol for risk-aware treasury management for DAOs. Generally, how it works is DAOs will choose, via community consensus, their objective function, a goal they want to solve for. Do they want, in maybe a lending protocol's case, assets in the reserve or the treasury to always be higher than liabilities? That generally makes sense. But you could imagine, different goals, making sure you have enough runway for 3 years or something similar like that. That DAO then makes an allocation to a self-custodied Aera vault. where they can deposit those reserves. As you mentioned, very often going to be the native governance token. It could also be some stables that it's accrued, or WBTC or ETH or things like that from separate reserves they've already diversified into. And then here is where it gets interesting. Effectively, a game is spun up, on-chain optimization game, where you have third-party guardians that are going to suggest rebalances across a set of approved assets, whatever initially came in, seeking to optimize that objection function or that protocol goal at assets greater than liabilities or something similar. Uniquely, this is sort of one click for DAO, as we sort of alluded to, getting the consensus when you need those funds or need to diversify is obviously much difficult. DAOs can do this with a little bit of one click. You choose your goal, you make a one-click allocation, and then that's optimized continuously. So you're not rebuying options or rebuying those derivatives as the liability or profile of the lending protocol, for example, changes. Not just the vault guardians who are submitting those parameters to that vault and defining that allocation. Then you also have the client protocol DAO, which we've mentioned makes the allocation. The third participant there is the arbitrageurs, who are basically executing the rebalancing and trading of those assets within the vault, which effectively acts as scoring the vault guardians. Vault guardians have a stake in this. They have to stake their requirement, and when they submit parameters, they're putting a stake up to make sure they're doing and they're properly incentivized to not be on both sides of the trade. They're not. You don't also want them to be the arbitrageurs who are going to pull money out of the vault or sort of extract value from the client DAO. This sort of game, when it works efficiently, should optimize dynamically against the objective function of the DAO. Now, like separate, we still need treasury managers for DAOs, right? There's still going to be operating expenditures and headcount and grants and other marketing initiatives potentially that you want to do. But if you can quantitatively calculate something holistically on chain, Aera can solve for this.
Interesting. So lots to break down there. On the protocol side, as they're defining their objectives, you must have a great insight into the different objectives that like a lending protocol might have versus versus a DEX versus some other type of protocol. Are you seeing like standard KPIs or goals or objectives? I know it's early days for Aera, but I would imagine that the different levers that certain types of participants on the supply side would want to set must become relatively standardized over time, depending on the different parameters of the risk metrics that they're trying to solve for. So just curious, any insight that you can share there, like maybe take a lending protocol for example, what are the types of attributes or things that they're trying to solve for? Because I would imagine that treasury managers, as they're starting to think about how to submit to Aera, would potentially benefit from knowing what are the what's industry standard.
And maybe we should help define that a little bit better. To your point, it's early days, and it's also early days. Gauntlet's been around for 4 years doing risk management for lending protocols, and still those risk appetites and risk profiles vary pretty considerably from Compound to Aave, and definitely upstart protocols that are trying to disrupt sort of the blue chips, as mentioned. Assets greater than liability is always going to be the thing for lending protocols. What that buffer should be, there really hasn't converged on a standard just yet. You can imagine, or at least I imagine right now, it's much bigger, and that buffer that everyone sort of wants right now, given recent macro events, is bigger than it will be in the next bull cycle. But yeah, too early to call that just yet.
So on the Guardian side, you mentioned that they have skin in the game, they're staking assets, and being quantitatively assessed based off of the success of meeting certain KPIs or metrics that the protocol has set. Feels somewhat similar to the asset management industry, where there's a 2 and 20 model, or some sort of performance driven compensation for managing assets. Can you am I thinking about that correct? And the Guardians, can they set their compensation parameters or how they're getting compensated, or is that standardized by Aera?
That will be standardized, but yeah, you're correct that there is some notion of reputation, right? So you're submitting these parameters, then they're aggregated across Guardians, then it's scored after each epoch. who got the best or worst score. You're either slashed if you sort of cause losses. You're rewarded if you perform better and got closer to that objective function that each individual vault or DAO is solving for.
How does a new Guardian get up on the platform? Do they have to provide some sort of a track record prior to being, given a mandate from one of the protocols, or is it, their track record is built through participation in the protocol over time?
Yeah, it will be over time. So right now, Gauntlet is the sole Guardian. We want to open this up as the protocol goes to V2, hopefully in coming quarters. But again, when you have skin in the game, you don't really have to gate that much, right? Everything's on chain and visible, and you're in a good spot. If you're putting your money where your mouth is, you can submit parameters to any sort of vault, and you're incentivized to do it right or solve for that objective function, epoch over epoch.
And when the Guardians are taking these mandates, are they able to effectively invest those assets into derivatives or other types of assets? Or is it, I guess, walk me through some of the investment strategies that you're seeing the Guardians put in place to be able to meet the needs for the protocol? Like, are they able to touch options or perps, or are they mostly just trying to find ways to diversify and have a quantitative, like an algorithmic strategy for diversifying from the native token into stables, given some sort of metrics that say we should, be de-risking the portfolio at this stage?
We'd be in a bad spot if we didn't leverage the composability of DeFi, right? This is something Gauntlet specifically is most bullish on across DeFi, of like how to use perps and options as those categories definitely grow. And the initial version and the initial vault that exists now is sort of an ETH and USD 2 asset vault. There will be more assets added, as well as derivatives and perps, as the liquidity for those makes sense to do so, and the slippage and other considerations are less of a concern. But yeah, we should of course leverage those, and that sort of makes the volatility or hedges that much better.
Absolutely. Okay. So I guess, if we put your Gauntlet hat back on a little bit, you're, as you mentioned, 4 years into, working closely with DAOs from a risk management perspective. Not only that, but you have a lot of insight in terms of just the B2DAO business model in general. And, I know there's a lot to optimize in the relationships there. So just curious, can you just share a little bit about, how do these agreements work? You're the VP of growth, so your job is to continue to grow, Gauntlet's client base, and to optimize for the growth of your clients. You're certainly incentivized in order to protect and grow the compounds, the Aves of the world that you work very closely with. But how do you kind of approach a DAO to begin with, and what do those agreements look like? Are they comparable to traditional markets, service agreements? Just curious what that looks like.
Yeah, they're very close to enterprise sales, I guess, in the sense that you're very often doing some sort of proof of concept. For Gauntlet, primarily, we did a market risk assessment for a lot of the protocols, compound included, where we highlighted a lot of stress factors, helped hopefully, get initial parameters out and sort of get the protocol on a steady footing as it started to launch and find its feet. Not surprisingly, as we're trying to manage market risk and we're in crypto, those market risk factors change all the time. Not only the prices and the volatility and the slippage of the assets, but the underlying, right? The protocol itself, the L1, everything like that changes. And this is why we sort of moved to a more dynamic or SaaS-like model, going directly to the DAO. And previously these risk assessments went directly to the core teams. Going to the DAO takes that enterprise cycle and puts a always on political cycle, where even though we've secured service engagements, we still have to convince the DAO and the community week over week to implement our recommendations or those changes or upgrades to the protocol or tunes of the parameters. So we need to make sure we're sort of structuring our service model and definitely how we communicate what is a lot of proprietary technology, and we've gotten better about opening up methodologies and data. And we think there's a lot of interesting ways we could do that in the future with ZK and get on chain to sort of, again, put skin in the game and put our money where our mouth is. We've started to do this with a insolvency refund, where we take a portion of our service engagement, and if there's insolvencies that sort of fall outside value at risk that we stated sort of solve for the protocol, we're effectively slashed ourselves and can pay out a little bit of a first tranche for users in the protocols, because it's tough to tell, right? Is Gauntlet just tweaking knobs in the back and making an LTV from a few percent up or down? We want to make that clear that like we're tied to the success, and the incentives are aligned with the growth of the people and DAOs we work with.
Can you, so I would imagine, given the environment that we're in right now, like the last 6 months, Gauntlet has been pretty busy across a number of different protocols. Can you kind of compare and contrast like what your engagement looks like with your client base in a bull market versus a bear market? I would imagine like, you see the volume of proposals, 2-3x what they were in a bull market, or do you feel like there's, consistent engagement regardless of the market cycle? Just curious if you can compare and contrast.
2-3x in the bear market, actually, where everyone realizes, oh, we shouldn't only be solving for capital efficiency, we should sort of balance these requests. And not surprisingly, risk management is, hey, like sort of the fly on the horse's back in a bull market, and we're told, go away, like don't worry about us, just let us list assets and sort of go up only, et cetera. But when the bear market, more people are at least attuned to sort of a risk-off environment and a bit more reactive than we'd prefer, which is difficult because governance is super slow. Getting consensus, on-chain votes, it's amazing how these payloads are fully executable code, and you can put them on chain, and once that vote sort of clicks yes and the voting period closes, the protocol is changed overall, but that's still slow anywhere from days to a week and change, which is not ideal for a 24/7 crypto cycle or market that never closes.
I would imagine, or I'm hopeful, that as every bear market cycle or every hack, every episode that takes place within DeFi continues to I guess encourage folks to be more actively focused on risk. And so hopefully on a go forward basis, it's not a boom bust, risk management cycle. That is definitely the hope, as volatility, kind of subsides to a certain extent, and this asset class becomes much more, similar to others where there's there's cyclicality in the market, but it's not, so, polar opposites on either end of the spectrum. And that, like, as the market continues to evolve, that risk management just stays at the forefront of folks' minds. It seems like you guys have, an interest in kind of the two most boring subjects of I guess, DAOs or corporate finance in general, which is, treasury management and risk management. Are you seeing, much more attention and adoption or I guess focus on these two areas, compared to previous cycles since you've been doing this for a few years?
Yeah, I'm excited. I think the seeds are actually planted to say like, oh, wait, some things are broken with the first iterations of DeFi governance. We should plant some seeds and have some faster paths for risk councils or sub DAOs that have, the effective big red button to stop sort of everything and halt when you really can't catch things or push through governance proposals, when exploits or potential price manipulations through oracles could happen or affect users. So I think those seeds are planted. We're trying to help inform conversations, not just in DAOs we work with, but just broader overall. Largely, I don't think regulators are going to sit by if consumers aren't protected and there aren't good practices for unfortunately doing the boring things like managing risk in treasuries.
I guess, like, when it comes to governance, is the challenge getting alignment, like, passing votes by, the required margin, or is it getting participation in these types of, I guess, or is it a little bit of both?
I think alignment for us, mainly because we're trying to push the edge of things, especially as it relates to risk. For others, it's usually just getting quorum. A lot of proposals you see in governance are sort of rubber stamped, and it's mainly just making sure that people have their keys to vote, which is often not the case for us. And hopefully, I think this is what governance should be. There should be contentious votes that win by slim margins, and we sort of make trade-offs. And this is what you're doing with risk management. Are you trading off risk for reward? And like, how should you think about that in different market cycles? So governance has started to be more active, more professional, and individual delegates across the ecosystems understand there's sort of a business opportunity to be had, and they can add value on different levels that are very clearly not our specialty: security risk, Oracle risk, and things like that. So
Right.
as this service stack starts to be built out, actually bullish for the stakes that we personally have in the DAOs we work with. We don't want to do everything or staff for everything as well, and we need help on the service side as well.
Yeah, no, absolutely. There's a lot to be built. I know, we benefit at Compound from the risk management expertise that Gauntlet provides, but also from others on, like you mentioned, smart contract audits and Oracle evaluations and all of the others. And certainly, helpful to have specialists in each of those areas, because I'd imagine that, the purview that you have across, multiple different clients or DAOs that you guys work with help you influence, whether it's introducing new protection measures like supply caps, or things that you evaluate in terms of liquidity of different assets, collateral factors. There's a lot that you can help inform, not just on existing protocols, but how to develop future protocols to continue to harden and strengthen the protection measures that are there, so that these continue to operate with success going forward. And having your expertise in a specific area certainly allows you to go deep in those different vectors, versus spreading too thin to be a full service, mile wide and an inch deep, versus a mile deep and an inch wide. So certainly helpful. Go ahead.
No, yeah, it's exactly that. Like, sort of when you're sort of the first service provider in a lot of these DAOs, you go at end to end by default, but it's not really by choice. It's that, like, hey, there's a lot of things to do, and hopefully we can help out and lend some guidance there, but not the thing we sort of want to build our specialty around. And everyone on the quant data science side wants to build sort of the most robust market risk management models, and it definitely makes us go a little bit or much too thin if we have to think about Oracle risk and other things.
Absolutely. Well, Nick, I really appreciate it. We covered a lot of ground here. Any closing thoughts?
I think DeFi has like this great opportunity this coming year to really distinguish ourselves from some of the disasters of centralized players that happen to be touching crypto, where we are really customer first, and if there's any sniff of bad actors or poor risk management, customers are going to withdraw their funds, as they very well should be and have the right to do so. Self-custody is pretty interesting, and hopefully we can highlight that value with just better risk management and continue to amplify like the value of the ecosystems and the chains and crypto that we're building in.
Could not agree more. +1 on everything that you just said there. Well, appreciate it. It's been a pleasure having you on. Would love to have you back soon. Thanks again, everyone, for joining. Subscribe to Compound Thesis on YouTube, Apple, or Spotify, and you can find all of our episodes at YouTube/Compound Labs. We'll be back in 2 weeks for another episode. Nick, thanks again. We'll talk to everybody soon.
Thank you.